Hey everybody, my name is Johnny, and today we're going to be talking about investing in the stock market, and specifically about how to pick your own stocks and invest in these companies and reap the benefits of them long term. So in my last video, because this is a series of videos, right? It's a series of videos about how to do value investing, how to pick your own stocks, right? In my last video, I made a statement that might have seemed kind of contradictory. I said that we as individual investors have a good potential if we learn our stuff right. We have good potential to beat the market, yet a lot of actively managed mutual funds that are run by really smart guys out of Princeton and Wharton and Harvard, a lot of them don't. Now, why would I say that? I just want to clarify, that's not out of conceit. That's actually factually true that a lot of these guys don't beat the market and that they're not as well set up for success as individual investors are. And the reason that I say that is because the entire mutual fund industry is basically self-sabotaging to these fund managers, right? These are brilliant guys, most of them brilliant investors, way smarter than we are. I'm not arguing that whatsoever. But the problem is that so many things about the mutual fund industry are, like I said, self-sabotaging, basically rigged against these guys so that they're not allowed to use their skill and their smarts to beat the market. And one of many ways that this is true is that they're managing millions or billions of dollars most of the time, right? And that is so much harder for them to be able to get in there and buy the stock that they want or get out and sell it, because it's going to be artificially driving prices up and down like crazy when you have that much money going in and out of different companies. Another reason is that they're using other people's money, right? They're using investors' money, and if we as the investor, if we get scared and say, oh, I want to pull my money out of the fund, they're not doing good enough, I'm afraid the market's going to crash, whatever, we can take that money, and guess what? Those guys are screwed. They don't have the money that they were counting on to be buying a stock. And that's, again, self-sabotaging for them. Another reason that they can't beat the market is that the entire mutual fund industry is super competitive, and these guys are all being measured against each other in the short term, right? They're being measured against each other by quarterly results every 3 months. And at the end of those 3 months, they have to post their returns, and guess what? The guys who aren't doing so well in those 3 months, they're out of there. They're fired. Obviously, they don't want that, and so they're not allowed to be able to use the advantages of investing in something long term. They're trying to get the best results that they can per every 3 months. And so it kind of devolves into more of a guessing game and a speculation, and just hoping that this company has really good results in a short amount of time. And that's completely counterproductive to the entire ideal of investing, right? It just becomes more guessing than anything. And so these guys aren't able to use their smarts and their investing skill and knowledge to be able to get good returns. Self-sabotaging. Another reason for this, and possibly the biggest reason that these guys can't beat the market, is because of efficient market hypothesis or efficient market theory. And basically what this is a bunch of academics got together and they saw that these guys most of the time weren't beating the market, right? And they said, wow, well, I wonder why that is, right? And they came to the conclusion that they're not beating the market because it's just impossible to beat the market. That's what they say. And they say that the market is so efficient and that every price is so accurately representative of the value of a business every second of every day that it's impossible to get around that, and you can't beat it. And that if you were to do it, it's just by sheer chance and sheer luck. So the problem with this is that they've gone a step too far. Truth is, the market's pretty efficient over the long term, and over the course of years, generally the price of a business will come to accurately represent its true value, right? Its true value based on its assets, on the management, on their cash and cash flow, their growth potential, right? And over the long term, it will come to be pretty accurate, their price to their value. But in the short term, it can go crazy, right? The price can be way above or way below their value because it's being driven by investors' emotions, right? The investors are buying crazy amounts of a stock, driving its price up for no reason, or selling crazy amounts of the stock, driving its price down for no reason. And the whole concept of value investing is to actually be able to take advantage of this. And guys like Warren Buffett and Peter Lynch and Charlie Munger, they have proven efficient market theory wrong over and over again by, like I said, by taking advantage of the fact that there are these giant inefficiencies that happen short term, and they can go and find these companies and buy them when their price is way cheaper than what it is, when it's not accurately reflecting the true value. And that's how they're making their money over the long term. And in fact, occasionally, even some fund managers can find ways around the way that the mutual fund industry is set up. And Peter Lynch, for example, he's one of the greatest investors of all time. He ran the Fidelity Magellan Fund, right? He ran billions of dollars for about 12 years and got 30% annually compounded return for 12 years straight. And guess what he did? He did long-term investing. He found good companies. He bought them when their price was way below their value, and he held them long-term, and he reaped the benefits of them. And guess what? Eventually, because the market's generally efficient long-term, eventually the price came back to or even above their value, and that's when he would sell and get the benefit of that return. So again, that's what we're trying to do. We're recognizing that long-term the market will accurately reflect the value of business and its price, but short-term it can be all over the place. And we're here to learn how to find companies that are good companies that we're going to get good returns from, and we want to buy a portion of them, buy their stock when the price is lower than their actual value. And so in my next video, I'm going to be going into some more specifics of how to do that. And we're going to be getting into all kinds of crazy stuff, crazy financial terms, and a lot of nitty-gritty hard work. But I hope you guys will enjoy it, and I hope that you guys will really get something out of it, and I hope that it will help you in your personal investing. I sort of rabbit trailed there. One thing that I wanted to touch on is I was explaining why a lot of mutual fund managers don't end up beating the market, and I delved into efficient market theory and efficient market hypothesis. And let me just say that this theory, even though they can't prove it, and it's in fact been proven wrong because several investors have actually beaten the market for years and decades even. Just look at Warren Buffett, and Charlie Munger, and Peter Lynch, and Bill Ruane. And they've proven it to be untrue time and time again. But still it persists, and it's such a prevalent theory that now mutual fund managers and the mutual fund industry, they aren't just measured against each other, they're measured against the market, right? And so if they have a quarterly result that's below the market, they can get fired for that too. And so now, instead of just trying to match each other, they're also wanting to match the market as closely as possible. So most mutual funds, not all, but most mutual funds are basically just following the market anyway, honestly. A lot of times you'll see they're just following the market, and then they might have some stocks that they've picked out here and there, but a lot of them are basically just closet index funds. And then you have the fees on top of that. So I hope that I was able to clear some things up for you, and I hope that I was able to help get you interested and help understand the concepts of value investing and how it can be more profitable to learn how to pick your own stocks out. Like I said, we're going to start getting into the specifics of that and how to find a good company and how to be able to differentiate between its value and its price. We're going to start getting into the specifics of that in next week's video. That's all I have to say about it for today. I do want to throw a disclaimer out there. I'm not an investment advisor. This isn't investment advice. This is my opinion. This is what I believe to be true and what's worked for me, right? I'm not your fiduciary. I don't know your situation. This is just what's worked for me, and my personal opinion, it's for entertainment and educational purposes only. Last thing I want to say before I go, I want to plug a product. There's a super cool company called PuraVidaBracelets.com, and this is just one example of some of the stuff that they do. If you can see it there, really cool product. If you're interested in this product, go to PuraVida.com and use the code DelaneyLang20 at the checkout, and you can get 20% off of any of their items site-wide. All right, so that's all I have to say for now. Please like, watch, share, subscribe, and I will see you in next week's video. See you later. Bye.